Have you ever just been completely overwhelmed when it comes to investing? Maybe you're just starting investing for the first time today and you're looking for somewhere to start. Or maybe you've got a portfolio, but you're not really sure, like, is this fitting the needs? Sure, it's going up a little bit, it goes down a little bit, but I don't know, do you need like an investing degree just to get started? Well, if you've ever felt that way, you're not alone. And you need to stick around today because I have a ridiculously easy 3-fund portfolio that's going to help you get started to be diversified, to be in the market, and to be building your wealth the right way. Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. Let's get into it. One of the things my grandma always used to tell me was, Nicholas, quit jumping on the couch. Nicholas, no dessert before dinner. Nicholas, quit punching your brother. Grandmas, they're the best. What was I talking about? Oh yeah. Another thing Grandma always told me was, keep it simple, stupid. And I don't really know if she was directing that specifically at me or if that was like just a general saying that she said. But in honor of Grandma today, we are going to keep it simple. We're talking about the 3-fund portfolio that your future self is going to thank you for watching this video. You see, by owning just these 3 ETFs or mutual funds, you can kind of do the combination however you like, you're going to gain access to thousands of companies, thousands of equities, thousands of different bond positions to help you be as diversified as possible. And get this, with just 3 funds, the average retail investor, that's you and me, can outperform actively managed investors. In fact, you're going to be the active manager 78% of the time. And how can I say that in confidence? Well, there's been many studies done that over a 20-year period, passive index investing actually beats the active managed investor. And guess what? You're going to save a lot of money in the process. And later in the video, we're going to talk about how much saving, even just what seems like a little bit, can really add up over time. So passive index investing not only beats the managers, but it saves you thousands of dollars. Let's talk about it. So let's do an example. Let's say your name is Susie and you are a social media manager and you're 30 years old. If you invest $5,000 a year for the next 30 years, because you're going to retire around 60 years old, you're going to have an average 9% return with this 3-fund portfolio. After those 30 years, investing $5,000 every year, you're going to have $804,000. And that's after paying $4,800 in passive index fees. What happens if you invested that money with an active manager, or maybe even, the financial guy across the street, or maybe the guy down the road that you know? What happens if you invest with that guy the same $5,000 over those 30 years? So again, Susie is investing $5,000 a year for 30 years, but this time she's investing it somebody with active funds and a fee. Let's call it 2% all in. That 2% is going to eat away at that same 9% return each year. Instead of $804,000 at the end of 30 years, Susie's only going to have about $563,000. And guess what? She's going to have paid $265,000 in fees over those 30 years. Yeah, $265,000. Now look, you might say, look, 2%, that's a little high. Let's knock the numbers down. Okay, example number 2. There's a lot of advisors that charge a 1% account fee or management fee or wrap fee. It's a lot of different names. So Susie, this time goes to one of those guys, fee-based only. 1% plus a couple management fees. Let's call it 1.25%. Same $5,000 over 30 years. What happens to Susie's money? Still getting the 9%. Well, Susie would end up with $662,000, which is better than the other guy, but she's still paying $147,000 in fees. So you've got some options. You need to retire. You need to save money for retirement. You can do a simple 3-fund portfolio and have $804,000. You can pay somebody 2% fees for active management and have $547,000, or you can pay someone for, again, active management and have around $600,000. Which one do you want to do? You see, fees really matter. They really, really matter because compound interest works on both ways. It compounds your fees on the way up. It also compounds your investment on the way up. By the way, if you're new here, my name is Nick, and at the age of 42, I retired, and I'm living off of my passive income portfolio as well as options trading, and that's what this channel is all about. Teaching you what I learn on a weekly basis so we can make better investments together. So let's actually talk about the 3-fund portfolio. The 3 funds, whether they're mutual funds or ETFs, I happen to use ETFs, but really doesn't matter in this particular case. 3 funds you are going to need: a total US equities fund, a total US bond fund, and a total world fund minus America, because you already have that in fund number 1. So those 3 funds are what you need to get invested in this particular portfolio. I've helped a lot of people develop these 3 fund portfolios for themselves. Let me give you one example. A couple years ago, I was helping my sister. She left one job and started at another. So she took her 401k from the old employer and put it into a rollover IRA. Now she has the choice of basically investing in anything she wants, but guess what? She has a full-time job. She's working at a real estate investment trust company. She doesn't want to actively time the market. She just wants a simple solution to get her invested. So we talked about the 3 fund portfolio: total US equities, total US bonds, and total world minus America. She rolled her 401k over to an IRA at Fidelity. So we specifically chose Fidelity funds because they were going to be the cheapest, low-cost fee for her. Let's talk about the funds that we chose. Again, if you're at Vanguard or if you're at Charles Schwab, you can choose funds within that. You just want funds that are total market. So here's the 3 funds that we chose for Monica. Her first fund that she chose was ITOT, I-T-O-T. ITOT is the total market US fund from iShares. It holds 3,354 total companies. The net expense ratio is 0.03%. They have a dividend yield of 1.24%. Year to date, 2025, they're up 7%. Over the last 5 years, ITOT has averaged 17% per year. And over the last 10 years, ITOT has been up 18.9% per year. ITOT has some top holdings of Apple, Microsoft, Amazon, Tesla, Nvidia, and then again, 3,354 other companies, which, as I mentioned, are all US based. Now, Monica has her US equities all set up, owning a piece of 3,354 companies. Now she needs some bond exposure. For the bond exposure, we talked about the US Aggregate Bond Fund, ticker symbol IUSB, which is also from iShares. The net expense ratio is 0.03. The current dividend yield is 4.10. With dividends reinvested, the fund is up 6.75% year to date. However, the average over the last 5 years per year was negative 0.5%, and they were only up 1.96% per year over the last 10. The top bond holdings are US Treasuries, US mortgages, and various bonds, totaling over 10,169 bonds. So now she's got her equities, now she's got her bonds. Let's talk about international equities. For the final fund of the 3 fund portfolio, Monica chose this. The Total Market International Fund we chose is the iShares Core MSCI Total International Stock, which is ticker symbol IXUS. The expense ratio is a 0.07%. It has an average dividend yield of 3%. Year to date, it's up 18.3%. It has averaged 7.2% per year over the last 5 years and averaged 4.3% over the last 10 years. Top holdings are TSM, Nestle, Tencent, ASM, Novo Nordisk, Louis Vuitton, Shell, Samsung, etc. There is 4,457 companies in that fund. Because my sister is only in her early 40s, she decided to be a little bit more aggressive with this particular setup, and between the 3 funds, she's 60% US equities, 30% international equities, and only 10% in the bond exposure. So how do you decide for you what particular percentage you want now that you know which 3 funds you want? Monica was 90% in equities and only 10% in bonds, but maybe you've heard, well, what about the 60-40 portfolio? Like, I hear that's a thing. And typically that means you're going to be 60% equities and 40% bonds. And the bonds are supposed to be the safe bet, if you will, compared to the equities. But with the 3 fund portfolio, you really have some options because you're diversifying in both US equities, international equities, and US bonds. So you've got a little bit more diversification than just the standard 60-40 portfolio. I'm a little bit more aggressive. So what I do is a 95-5 portfolio. I'm 95% invested in equities and only 5% in bonds. And really, I don't even know if I want to be that much in bonds. Lately, I've been kind of leaning towards more large cap dividend stocks than I have actual bond funds, but everything's up to you. The traditional thought by financial advisors is you take 100, minus your age. So if you're 50 years old, you're going to take 100 minus 50, and you should be in a 50-50 bond split. If you're 20 years old, 100 minus 20, 80% equities, 20% bonds. Again, 40 years old, well, 60% equities and 40% bonds. Got it? Perfect. So Monica's choosing 90% equities and 10% bonds. And over the last 5 years with these 3 funds, she would have been up 12.62%. Over the last 10 years, she would have been up 9.87%. So she's right in line with market expectations. She's fully diversified over thousands of companies, and she has some bond exposure, and she's saving thousands of dollars over actively managed fees over a 30-year time horizon. If you wanted to get a little bit more aggressive with 95% equities and only 5% bonds, your portfolio is going to go up to 13.79% over the last 5 years and almost 10.5% over the last 10 years. So, again, it's up to you. Look at your own risk analysis, but I don't think people need to be afraid of equities like they are, because you are so diversified. You're talking about a long-term time horizon, and you own so many companies that you've got a big safety net helping you up. So that is the classic 3-fund portfolio. And that has historically been a very safe, well-diversified option for many investors. But in my book, The Quick Start Guide to Investing, I also discuss the new 3-fund portfolio. And there's a few tweaks. It's a little bit more aggressive. It changes out a little bit of bond structure. And you can grab that book at any good bookstore that you like. You can even use online bookstore if you want. Or you can like and subscribe, and we'll talk about the new 3-fund portfolio in an episode coming up. That's it for today. I hope you enjoyed it. I hope you learned something. This channel is all about teaching you the things that I've learned over the years, both as a financial advisor and as a retail investor, and now as a 43-year-old retired guy who's loving life, currently at Lake Michigan, but normally in southern Spain. We'll see you next week. Take care of yourself, and if you can, somebody else too. Thanks for joining me today on 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.